Yes, I'm here, Michael, and good afternoon to everyone. And definitely, I think that this panel, in this time of crisis, with liquidity is essential to maintain key businesses up and running. I think nothing is more essential to understand what working capital solutions are and the investment opportunities in order to support not only the business in this time of crisis, but the reveal of the U.S. economy is going to be key to all these companies that support somehow to free cash that is trapped in different industries. So we're going to go through 4 panelists in different investment opportunities with different strategy, but at the end, you're going to realize that all these investment, the final objective is to turn out cash and give it back that to the market and to the companies. So in general, working capital solution is the use of financing and risk mitigation practices technique to optimize management of working capital and liquidity. And that's what you're going to see through. So we're going to go to each of them. They're going to introduce themselves and they're going to introduce their business. Then we're going to pose and I'm going to ask them general question. We're going to get those answers and we're going to open to the participants to ask all the questions and have this as interact and interesting in front of us. So we're going to start with Mike Griffin from HedgeAct. Mike, are you there?
I am. Thank you, Shalako. Can you hear me okay?
Perfectly. Thank you.
Okay, wonderful. My name is Michael Griffin. I'm the founder and CEO of HedgeAct. HedgeAct is a registered investment advisor who sponsors niche alternative strategies that seek to provide superior alpha-generating risk-adjusted returns that are not correlated with the broader asset classes. We sponsor several hedge fund strategies that in aggregate represent approximately $250 million in assets under management. Today, I'm here to introduce our medical receivables litigation finance strategy. This fund is a fully secured lending strategy. Our medical receivables litigation finance fund provides loans to receivables companies who deploy the funds to purchase medical receivables from their network of medical service providers. Our financing provides victims of personal injury cases the ability to obtain the medical attention they require immediately at no personal cost, thereby providing a much needed social benefit. This is simply a collateralized lending strategy secured by an assignment and/or lien on the underlying purchase receivables. Such receivables represent 200% or more of the loan amount. To secure our loan further, we additionally have a UCC filing over all of the assets of the underlying receivables companies. So it's important to note that our fund is not purchasing receivables, but simply loaning money to underlying receivables companies who we have vetted through our due diligence process. We have a stated interest rate and specified loan terms. Our loan repayment is not subject to the success of the underlying cases. It must be repaid by the receivables company irrespective of such success. Accordingly, interest is accrued and collected monthly. Therefore, there is no mark-to-market or corresponding portfolio valuation issues. Next slide, please. Thank you. In terms of performance, the fund targets a mid-teens to low 20s return with minimal, if any, downside volatility. We generated a 17.5% return during our first year in line with those expectations. Our fund revenues are derived as follows. We charge a 19% per annum interest rate plus a 6% fee on the loan draws due once the loan has been repaid. In some instances, we also charge a 2% origination fee on the funded draw. I'd like to talk a little bit about the receivables company. So if you'd go to the next slide, please, that would be very helpful. Our team relies heavily on the underlying receivables companies. Our receivables companies are leaders in their market. They have outstanding underwriting skills with a track record of above market collections and a correspondingly negligible write-offs. Significant value proposition of the receivables companies bring to the fund is their vast network. Victims of personal injury claims are sourced through a national network of lawyers who are willing to take a personal injury case on a contingency basis. This is the receivable company's first line of defense. They will only underwrite cases referred from one of their contingency-based lawyers who are convinced as to the merits of the case. The receivable companies also have a vast network of medical service providers. These providers include doctors, hospitals, MRI centers, pharmaceuticals, and physical therapy treatment centers. In return for client referrals, which can occupy unused provider treatment capacity, and for immediate payment, the service provider will considerably discount their fees to the receivables company. Particularly true during this current environment. During this pandemic, there are more medical service providers seeking to monetize their receivables as delays in the court systems make it more appealing to work with our medical receivables companies to improve their cash flow. The spread between what the medical service providers discount their fees and the amounts received through the litigation settlement is the profit opportunity for the receivables companies. This can be very profitable, generating upwards of 50 to 100% on purchase receivables. So in summary, the receivables companies are willing to finance their business through our fund lending and capitalize on the relationships to generate outsized profits. The victim is treated expeditiously and returned to health, and our investors earn a superior risk-adjusted return. Thank you very much.
Okay, thank you, Mike. And we're going to continue with Elliot Goldberg from 1931 Funding LLC. Elliot, I turn to you.
Hi, Scirocco. Can you hear me?
Yep, perfectly. Thank you.
Oh, great. My name is Elliot Goldberg, and I'm the manager and owner of 1931 Funding LLC. In the next couple of minutes, I will introduce you to an asset class called Merchant Cash Advance and 1931 Funding as an investment opportunity in that asset class. If you'd like to download this presentation deck, just go to 1931funding.com. Scroll down a little bit and click on the button, Download Brochure. Next, please. Next. Couple of slides. Next again,
So,
please.
Elliot, tell me when to stop.
Okay, the fifth slide. Keep going. One more. Okay. First thing I want to show you are the attractive investment options. As you can see, these fixed returns run from 6% annually for 1 month commitment to 20% annually for a 5-year commitment. Next, please. $1931 is a company that provides short-term cash advances to small businesses, we call merchants, to help them fund their growth. It does this through a network of funding firms. If you can open up the rest of those buttons, please. Thanks. It does this through a network of funding firms that identify merchants that have a need for short-term cash advances and underwrite them for the ability to repay their advance, provide collection services from the merchants, and remit daily and weekly payments to 1931 Funding for its share of the cash advance that it has participated in. These are called merchant cash advances. Next, please. Keep going. A merchant cash advance is the purchase of a portion of a merchant's future receipts in exchange for providing cash to the merchant today. They're needed because few banks currently cater to the needs of small business merchants, and those banks that do typically require a lengthy period of time for processing these requests. Successful and growing merchants have immediate cash flow needs, and banks are not able to meet this timetable. Continue, please. Merchant cash advances were designed to meet these needs. We're going to go through a quick example on the next page. Keep going. This is Joe. Joe owns a growing oil delivery company with 3 trucks. He wakes up one morning and finds that one of his trucks is broken down and needs to be replaced ASAP. He needs 50 grand, so he calls the bank for a loan, and they are just not responsive. So he's really stuck. Next slide, please. Keep going. He figures he's going to lose about $100,000 of profit over the next 6 months if he doesn't get a truck on the road and have some very unhappy customers. So he contacts ABC Capital, which is a funding firm in the merchant cash advance space that might give him that $50,000 he needs. He gives them the information they need, and ABC Capital tells them that they'll actually advance him the $50,000 to purchase his truck if he agrees to pay them back based on his future receivables at $600 a day for the next 120 business days. Joe agrees, signs the paperwork, and then gets a wire into his bank, and he goes and picks up the truck the next day. Next, please. ABC Capital, the funder, wants to reduce their risk of default on this merchant cash advance, so they contact firms like 1931 Funding and offer them a chance to participate in the cash advance. In this particular example, 1931 Funding takes 10% of the deal, and they have to pay the $5,000 plus an acquisition fee, typically 15%, sometimes less. So let's say $57.50 in. Over the next 6 months, they'll receive $68.40 back, which is an annual return of 45+%. Next slide, please. Here are a couple of the industries that merchant cash advances are in. As you can see, they're all over the board here. There's probably 30 of them here. They go from accountants to environmental, insurance agencies, limo drivers, lawyers, moving companies, construction, just a broad portfolio of industries. Next, please. So how can 1931 pay investors such high interest rates? There's a conservative 45% annual return on each successful MCA. We get daily and weekly payments and cash flow, which can be reinvested in new ones. Some of these MCAs are renewed and paid off early, which increases the IRR to the company. And for diversification, I have agreements with 20 different funding firms like ABC Capital for diversification. My job as manager is to monitor the results of each funding firm's MCAs and allocate funds to the firms with the best anticipated risk-adjusted returns. Next, please. And here's a schematic of how it works. A subscriber subscribes to an offering with 1931 Funding, and then 1931 Funding funds advances to merchants through the funding firms. Next, please. Again, here are the options. They run from 6% annualized for 1 month to 20% for 5 years with monthly payments and without monthly payments. Also available in IRAs, profit sharing plans, and obviously personal accounts, trusts. Next, please. I provide a balance sheet every month to investors and prospects. Obviously, getting your money back is most important, and that's the reason I provide it. Next, please. I provide a section on assets. I won't go into it now, but if you download the brochure, it's in there. Next, please. I have the liabilities. Again, I won't go into detail. People want to talk to me about it, I'm happy to. But this is important, this other metrics. There's the first line here, bad debt percent threshold to offset equity. Currently running about 15% bad debt. It would have to get up into the 30s before it eats through the equity in the fund to pay the investors their interest and principal. So the buffer is 18%. The average investment per MCA is about $5,000. The average maturity is 22 weeks. The average factor is 1.46, which means every dollar we put out, we'll get $1.46 back. I've got 20 different funding firms I work with, and as of the end of February, we have 4,700 advances. I see there's a couple of questions.
Elliot, why don't we wait until after to take the questions?
Okay. Next screen, I think there's maybe one more. Yeah, this is just a historical chart of the growth in equity of 1931 funding, just to give you an idea of its strength. Next screen. Okay, how do I make money? I get 10% management fee, which are built into the financials that you've seen, plus the remainder of the equity. What happens if I'm not around? The portfolio goes into runoff mode. And what happens if the economy turns down like it is now? And basically, it's not theoretical anymore, it's historical. And what I've seen is a slight pickup in bad debt. We're running around 15.8 to 16. And the deal flow is contracting, and the deals I'm seeing have shorter maturities and higher factor rates, which will help down the road with the portfolio. And again, if you want, I can take questions, or we'll take them later.
Yeah, let's do it later.
Okay.
Yeah, sorry, Mike. Let's take it later, or you can type an answer while we ask Rafael Serrano to introduce us Safe Harbor.
Yes, thank you. Can you guys hear me okay?
Okay, thank you. Rafael.
Yes, we can.
Okay, great. Thank you, gentlemen. Well, good afternoon, everyone. My name is Rafael Serrano, and I am the managing partner of Safe Harbor Equity. Safe Harbor is a real estate private equity firm whose core focus is the acquisition of distressed, non-performing loans secured by real estate, i.e. bad real estate mortgages. We founded Safe Harbor in 2005 and have successfully generated above average returns for our investing partners that are uncorrelated with the broader markets. To date, we've launched 3 fund vehicles that have generated mid-teens to low 20s net of fees over the last 14 years. Next slide, please. Thank you. So this slide discusses the competitive advantage and the opportunity set. The traditional banking sector, as a result of regulation and capital market requirements, consistently allows for market inefficiencies to be exploited and value to be extracted in the distressed, non-performing loan real estate space. Specifically, traditional lenders, i.e. banks, are focused on making money through interest income. They are not set up to handle non-performing loans or navigate the long, drawn-out workout process. This provides Safe Harbor Equity an opportunity to extract value and act as a service provider for the banks. Next slide, please. So this slide discusses some of our competitive advantages. Amongst our competitive advantages is our ability to execute transactions and work with lenders as a trusted partner that they know and have worked with for over 14 years. Additionally, we extract value from each investment through our expertise in litigation management. Further helps us navigate the foreclosure process and expedite the recovery and monetization of the investments. Underpinning some of our advantages is credit underwriting, a detailed analysis and due diligence that are at the backbone of extracting value and capitalizing on opportunities. We conduct an in-depth financial analysis of the borrowers, the collateral analysis. We maintain a strict adherence to value parameters and lending guidelines, as well as having a high-touch in-house loan servicing servicing platform that provides greater opportunity for payoff through litigation management. Next slide, please. This slide touches on the market opportunity, which further elaborates on the opportunity set and is very appropriate given what's going on with Corona. The US mortgage market is huge in size. It's $15 trillion market size, with approximately $4.5 trillion in commercial mortgage loans. Even a small percentage increase in non-performing loans provides billions of dollars of opportunities to extract value. Our goal with most non-performing loan purchases is to work with the borrowers to establish a plan to get the loan payments up to speed. If necessary, we go through the foreclosure process and we'll take title to the underlying collateral, which we believe is a high quality asset with significant value above our purchase. Next slide, please. Oh, actually, the next slide, I believe we did not make it into our presentation, but it was going to be a couple of examples, which without the slide, I can certainly just simply elaborate at them on a high level. I'm gonna walk us through a simple example of an active transaction. We acquired a loan from a lending institution that was in default. This loan was secured by a piece of collateral with a value that we estimated it to be at $14 million. The loan had a face value of approximately $7.5 million. We paid $7 million for the loan. We then proceeded to navigate a workout with the borrower in an effort to try to restructure the debt. We were unable to restructure the debt with the borrower, so we prosecuted the foreclosure action. We took the property back into a foreclosure. It took us approximately about 18 months. We then sold the property for $10.25 million. That contract is actually pending as we speak. We took a deposit for $1 million hard. And when you look at the metrics, we paid $7 million for something that we sold for $10.25. So we made approximately $3 million on a $7 million investment, which we did lever. So our equity multiple was significant. That is pretty much an example of what we do. I have multiple examples, but I will save any of that for the Q&A after. That's it.
Thank you, Rafael. So, Shalako, we can't hear you.
Okay, no, I was saying that, you hear me now?
Yes, we can.
Hello? Okay, perfect. So now we're gonna turn to Enrique Musi from eFactor Network. Enrique, the floor is yours.
Hello, thank you. Hello, everybody. You can hear me?
Yes, Enrique, thank you.
Excellent, thank you. Well, my name is Enrique Musi. I'm the business consultant for eFactor Network. I'm responsible to implement eFactor Network in the USA. To start this presentation, I would like to mention who we are. We are eFactor Network is a fintech company that provide marketplace through web services that connect corporate services with their suppliers and clients, with financial institutions, and facilitates electronic financing solutions for short-term working capital. One of our strong things is we take advantage of the north border clients that we have in Mexico. We have a very strict credit procedure and a strong market support. But what is the main importance for us is that we create with the vision of the founders of this company that was created in year 2008. It's a multi-platform of multi-funding electronic systems. And that's after 12 years, it's a contracyclical company that have been growing at rates of 20% year after year. And also we have another company with us that it's called eFactor DS. Please return to the back slide, please. eFactor 10, it's a financial institution. It's owned by eFactor Network and it's oriented in electronic factoring operation to suppliers. And it supports financial institution connectivity for factoring on the eFactor Network platform. Also, as you can see, we have a lot of acknowledgements from different sources. Next, please. Well, what we do, we find the qualified client, work with them and trying on solution on working capital and rentability optimization, funding and operation risk management, funding and orientation to suppliers. And all of that, we will provide with them a tailor-made structure using the technological platform for strengthening corporate enterprises funding decisions to the supply chain finance, mainly. Next, please. Okay, we have two very great partners. One is the IDD, and the other one is the International Finance Corporation. They found us because we show our leadership because we become the first company, private company, fintech, in get funding to the small cap companies, Mexican small cap companies, using electronic platform and a very competitive rates. They also check that we operate with 0 defaults from our good credit analysis, our responsible management, our 100% committed and compliance, 100% electronic trading, scalability, replicability, and profitability. Next, please. Also, our international multi-bank platform allows to work in 21 different countries with 3 different currencies. We transact in dollars, Mexican pesos, and euros, and 60% of our income comes from dollars. We have offices in around all the Mexican territory. We have offices in Spain, in South America, and in the US. We have partnership with some other factoring companies, and as you see, we have a multinational presence at this time. Next, please. Also, we have been working with more than 100 corporate clients. Just in 2019, we grow our base in 20 new ones. We have multinational Mexican clients like CEMEX or NIMAC or CUO, among others. And also we can do transactions with multinational companies worldwide, like Home Depot, Kellogg's, for example. Next, please. Also, we have working with our funders, it's like 30 financial institutions. We expect to grow with 7 new ones for this year, with different institutions around the world. As you can see, we can work with Japanese bank, US bank, Mexican banks, European banks. So our platform is well knowledge around the world, and every year we have a very good impact, as we have been working in the past 12 years. So I think that we will move on to still growing with the same rates of 20% at least per year. Next, please. And finally, what we are going to becoming a multinational company aided by private equity funds. This is very important. Develop locally and overseas, with developing a US client base on current US border marketplace that we discussed before. Also, we want to increasing our 60% income to 80% income in US dollars. And in the near future, we would like to becoming a public traded company with our current operation standards. And of course, keeping on leading innovative software development solutions. So after surpass this bad environment, I expect that more sooner than later, you will hear again from us. Thank you.
Yeah, thank you so much, Enrique. And now, just before we open the floor, I would like to go through the panelists for a couple of questions and get their feedback. And basically, it's how their investment opportunity had a good risk return during this crisis, and what are the major risks on investing on that, and how they mitigate it. So we will start by with Michael.
Thank you, Sherlocko. So again, this is medical receivables litigation finance product. Because we are lending at most only 50 cents on the dollar, the loans are fully collateralized with an assignment or lien on the purchase receivables, and we have a UCC filing on all of the assets of the underlying receivables company. The credit risk is virtually mitigated. The remaining risk is really fraud. And fraud could conceivably be perpetrated if the receivables company were in collusion with the medical service providers to create fictitious billable services. We mitigate this risk first through our loan draw diversification. The draw requests cover hundreds of service providers nationally with virtually no concentration risk. Next, we have multiple receivables companies focusing on different geographical sectors of the country. And finally, we physically inspect each draw request. We ensure that each is supported by documentation from the medical services provider, and that our fund has the appropriate assignment and/or lien to perfect our secured interests. Again, we are not relying on the settlement of each case to secure repayment. The loan is required to be repaid irrespective of the underlying case settlement. Back to you, Sherlocko.
Okay, thank you, Michael. The same question for Elliot.
Okay. In terms of the risks, the portfolio is very diversified, as you saw before. At the end of March, we'll have over 5,000 pieces of advances. Given the current crisis that we're going through, we no longer have to be theoretical living through it. The bad debt rates have inched up to in the high 15s at this point, but there's a lot of equity in the company sitting behind it. Funders are adjusting to it by not writing for restaurants and travel. They're writing doctors. I've seen OBGYNs, I've seen construction for large builders, all with the theme of not being affected by the coronavirus. And the factor rates are higher than normal, and the advance length is shorter than normal. So that over time, these will perform better than the other ones and bring the averages down to what is a very acceptable 15% on bad debt. The funders are very aware of it. They're working out with certain merchants who need help. They're suspending with merchants that need help. But in speaking with all of them, I get the feeling that things are under control and we'll be fine coming out the backside of this.
Excellent. Thank you so much, Elliot. Rafael?
Yes, please. Could you just repeat the question one more time?
Yeah, the question are, what your investment opportunity are good risk return during this crisis, and what are the major risks that you see on your product and how you mitigate it?
Certainly. Well, I think that this crisis is very unfortunate, but in fact, what it does is it creates an even greater level of opportunity for people that are in our space, right? the amount of distressed assets is about to increase substantially. We are already receiving a great number of calls from our lending partners who we acquire debt from. So we see this as an opportunity to certainly expand what we do. In terms of the risks and how we mitigate it, we have a very strict policy of not acquiring anything that we don't buy any debt unless we are at 50 to 60% loan to value. So that presents at the very minimum a 40% margin of equity before the market corrects and we are at parity. And certainly we don't buy while the market's going down. Now, to be clear, we've been doing this since 2005. We are in our 15th year of doing it, so we have already gone through a cycle. And I can tell you, that in the 14 years of doing this, we lost money on one transaction, which totaled $65,000. And we have done hundreds, if not thousands of transactions. And that's because we very strictly adhere to that parameter of maintaining a minimum 40% loan to value ratio from the acquisition price. And that is how we mitigate that. Now, certainly times are changing, so we're keeping an eye on the ball and we don't rush to make investments. We have a saying internally, and that is that we are in the stay rich business, not the get rich business, because our primary focus has always been the preservation of capital. Now, we do benefit from having substantially very healthy returns, but that, again, we're not looking to hit home runs here. We're looking to stay safe with the capital that we get, but we do benefit from having very healthy returns. And how we mitigate it is to adhere to our underwriting disciplines.
Excellent. Thank you so much, Enrique. Sorry, Rafael. Enrique, the same questions.
Yes, thank you. Mexico suffered 1 year ago. They didn't grow, even decrease 0.1%. So eFactor network was prepared on a bad scenario. Even that, the company grew 20%. Also, we collect some liquidity and we enforce our credit procedures and get credit support to our investment rating clients. With this situation, we remain with 0 defaults, and also we expect that the credit spreads will increase in the near future. So for us, as I mentioned in my presentation, this is a contracyclical company, and we expect to grow more because some parts of the supply chain going to be broken, and it's there when we are to support that important companies that we work. So I think this more like an opportunity, and also, as we mentioned before, we are prepared because last year for Mexico, it wasn't a good year, so we took caution, and now this caution is helping us to surf this wave. Thank you.
Okay, thank you, Enrique. So before opening to all the questions, I want to see that through all these different presentations, at the end you see there is different technique and opportunity to invest. So at the end, what all these opportunities bring to the table is the free cash that is trapped in a distressed asset or in a business that is growing or in litigation. Or you have an interest in also platform that connects suppliers to buyers and through different techniques. So open up to the question. I think that Elliot, you have the 3 initial questions that if you want to take it and give it an answer, and then sure. There is a question for, yeah, sure. Go for it.
Should I go now?
Yeah.
Okay. The first question is 1931 equal to or senior to the lender? The answer is that we are taking a piece of the lenders, so we are right on par with the lender. Second question is, how does the shutdown of a lot of these industries in America affect or eventually affect your business? And the answer is not well. But as I said before, I expect the bad debt rates to tick up. And there will be workouts and there will be suspensions. But on these workouts, things like this have come before when there have been tornadoes and hurricanes. There's always been suspensions of payments. The funders actually reach out to the merchants and try to work with them. They don't want to put them out of business, obviously. And the third question is, do you have your own personal investment funds in 1931? The answer is yes. On the balance sheet that's in that presentation deck, at the end of February, I had $721,000 of my own money. I put in an additional $150,000 this month just to shore up the balance sheet and to give comfort to investors that I understand their concerns and just putting more equity in for them to be comfortable.
Okay, thank you so much, Elliot. The other question comes from Victor Russell. I'm not sure if I understand probably if they're looking for a buyer or someone that financed the transaction, but I don't know, what are your thoughts, Enrique? I think this is addressed to you. Enrique?
Sorry, can you repeat the question, Chalaco, please?
Yeah, the question that is online says there is a China supply chain that can produce COVID-19 supplies, materials, and ventilators, etc., as listed below. Enrique, how fast can I speak to you on financing? Please provide a number. This is from the supplier. Apparently, the supplier sent my quotation for normal instant face mask at 30 cents per unit, FOB Shanghai, 95 medical face masks, 70% FOB Shanghai. So it goes through the list, and then there is a real bottom price situation. Now I want to supply it, but I don't know which company takes charge of the procurement. So it's looked to me they're looking for a buyer more than the financing part.
Okay, we will refer him with an expert from the company in Mexico, and see if our market our market platform can support with someone that required them. So I will bring him the data from the
okay. I think with Mike Corcelli, we can get the contact from Russell, and you come back there. They're looking for financing and buyer. Then there is a question for Rafael about Rafael, any property types that you won't do? Do you source via auction platform or directly from the banks? So Rafael?
Yes, absolutely. No, we yes, we have a very specific focus, and what I mean by that is we focus primarily on what is called commercial paper, not consumer paper. And just to clarify, consumer paper means commercial loans, but the underlying collateral can be a residential asset if it is an investment property, an income producing property, a multifamily residential. In those cases, the collateral will be residential, but we do not do individual primary residences, single family homes that are owner occupied. We do not do that. So our core focus is commercial paper. Is that, was there another part to that question, or was that it?
That was a question. I don't see another part. Then additional put commercial mortgages only make sense and the sourcing, that's the second part of the question.
Oh, I see. Yeah. No, we do not go through auction sites. Typically, everything that we do is off market, and it's not intended to be that way. It's it works out that way. Lenders prefer to work with groups that they know and trust and already have a relationship with, because when you sell a loan to an organization like us, ultimately we are stepping into the shoes of the lender, and you have to have the ability to work hand in hand with the lender who's selling the loan. And that typically requires a level of trust and a relationship that is not easy to do when you're buying a loan on an auction site. So if you're buying a loan on an auction site, you're really buying it as is, where is, with no representations and warrants. And there is successor liability when you buy debt. So lenders understand this, and we certainly want to work with people that if we have to litigate, which is very often, we want to be able to have a relationship with the lenders. And it's really very, very fundamental in the commercial loan space, because unlike the residential loans, that the average size of a residential loan is a couple $100,000, commercial loans are, 2 to 20 and up. And those borrowers do have a lot of firepower. They are sophisticated, and they can't mount an effective legal fight. So being able to partner with the lenders on the litigations when they present themselves is fundamental. So that's one of the primary reasons that we do it through relationships, and vice versa. Lenders want to work with people that they have a relationship with as well.
Okay, thank you so much, Rafael. Also, there is an additional question. They ask you about any ground-up construction funding.
Do we do ground-up construction funding? Is that the question?
Yeah, I think that's the question.
Yeah, no, not typically. We will opportunistically originate debt. It's not to say that we won't, but it's very opportunistic, and by meaning that we have to feel extremely comfortable in the case that we will originate a new mortgage. It's a possibility, but it's very situation specific.
Okay, thank you so much. I don't see other questions, and we still have 10 minutes to finish. So I will leave, let's do like 2 or 3 minutes to each of you to give your conclusion and your expectation, and then we move to Michael Shelley. So Michael Griffin, your question?
Hey, Shalako, I'd just like to interrupt for 1 second.
Yeah, go for it.
I'm actually the next presenter, so I'm willing to give up some of my time so that you can extend this panel a little bit, like, I don't know, 15 minutes.
Okay, perfect. So there is another question that just came out to Rafael. Will you look into preferred equity investment?
I'm sorry, will we do what?
Will you look into preferred equity investments?
Not typically, no. We typically, I think, so is the question that will we make an investment and take a preferred equity position? If that's the question, the answer is no. We strictly only buy first position mortgages secured by real estate.
Okay, so let's just do a quick roundtable with final words. So I'm gonna turn up to Michael Griffin.
And the question, Sharako, is just
I would say that as we have additional time, just to go over how you see like size of opportunity that any investor wanna see with your firm, and maybe some final words about
thank you.
Situation and yeah.
So this opportunity came to us through another opportunity that we have for one of our fund-to-fund products, and we noticed that one of our receivables company had been doing this for another fund for about 9 years, and we basically partnered with this other fund and improved the strategy in terms of interest rate and greater fees for our investors. But while our fund is only a little over a year old, our receivables company has been doing this for 20 years, and the fund that we partnered with was generating 9 to 10% per year for 9 years without a single drawdown. So we really like the strategy. We like the security aspect of it, but we really like how we package this as a loan that has an interest rate that will be very good for our investors and not correlated to any of the other market asset classes. And so we are seeing that with the pandemic that occurs right now, that there are more people looking to finance their medical receivables. And while the industry is very large as it is, 35 to 40 billion dollars, we can put a fair amount of money to work. And we expect that we'll raise roughly $100 million for this strategy this year, so long as we can deploy it, but that looks not to be a problem at this juncture. So that's kind of my summary right now, and I'm happy to answer any questions or elaborate on anything that anybody may have.
Okay, thank you so much. Elliot, in your business, how do you see right now during this situation, investors interacting or interested in your product, and an idea of the size of the ticket that you're looking right now?
Well, from the overall investment scenario, when we have shocks like we have, investors tend to pull back. That's going to be, I would be sure, in every asset class of everybody on the panel. But what happens is that over time, people get comfortable with it. They see a solution. In terms of my particular fund, it's 2 years old this year. This is obviously the first time that we've gone through a shock like this. But I've spoken with the funders on many different occasions about this particular thing, some of which who've lived through it. And they basically tell me the same thing of what's been going on now. We get funds, investment funds pull back. There is more demand for merchant cash advance money. And because of that, the funders can do a better job of underwriting and really cherry pick the best deals. So that is why during my presentation, I said that I felt that the deals that are being written yesterday, today, tomorrow are going to be very good performing deals just because of that. In terms of where the entire industry is going, banks are not going to be any source of funding. It is amazing how many companies are out there that are accepting of this type of financing. They view it as short-term and quick, and it's been growing about 20% a year. I don't know if any of you have seen the commercials on TV from Cabbage, which is a funder. I don't work with them. They don't need my money, but they do $2 billion themselves. Square is becoming a funder, American Express, Amazon. It's becoming very mainstream, and I just see it being a major source of funding going forward. So hunkering down now, watching numbers very carefully, talking with funders, and we'll get through it.
Excellent, thank you so much. And Rafael, before having your final thoughts, and I know that in this scenario you have a lot of opportunity and a lot on your plate right now. There is an additional question that rises to you. So may I have missed it out, but what is the typical first lien mortgage range for your shop? They put example between 5 to 200 million or whatever. You want to take that and give us your final thoughts of.
Yes, certainly. So the question again is, what is the typical size of our investment acquisition? Is that correct?
Say, typical first lien mortgage range for your shop.
Certainly. So our typical mortgages that we buy are in the range from 2 to 20 million. That is what's typical for us. And I'm sorry, I've got my dogs in the background. Working from home these days. Give me a second. Let me close this door. So typically, yeah, so our mortgage investment size are 2 to 20 million. And just my general consensus on what's going on, obviously with Corona and the situation of late, is that there is a tremendous amount of opportunity and there's going to be a tremendous amount of distressed debt. We are already seeing a lot of activity from the lenders that we work with because it's a trickle-down effect, right? This is unlike the crisis of 08 that we navigated effectively. This is very different to the extent that we're seeing a complete shutdown of the economy and it's grinding to a halt. And while there were waves of defaulted mortgages that took place throughout the crisis, people were still working. And one of the basic tenets of lending is repayment capacity, which comes from employment, right? Cash flow. And this is a very interesting time that we're living in. This is unlike anything we've seen, right? So it certainly begs the question, and one has to be cautious. But I am optimistic that it is going to, obviously work itself out. But it is certainly, there's a time of uncertainty here, but we feel comfortable that we're going to be able to navigate through it and make the best of it. So that is really, that's how I would characterize it.
Okay, excellent. And finally, Enrique, if you have some closing word for the panel.
Thank you, Shalako. No, I think we need to surf the wave. I think the measures that we heard from the government and the Congress are helping to recover the economy, but in the meantime, we're gonna feel some pain in some industries. But we, as a part of the supply chain finance, we have to be very smart on what we are doing now to help the market to recover as quick as possible and to try to avoid some credit crunches that we have been faced in the previous crisis of 2008. So I think now the market is much very well prepared than 2008. And I think in probably 4 to 5 months from now, we have been in much better shape and probably return to the growth from the country.
Okay, thank you so much. Mike Cortelli, we still have time. We have 2 additional questions, one for Michael Griffin and the other one for Rafael, but I don't know if we're running short of time right now.
No, you're not running short. You can use some extra time, and this has been a very interesting panel, so keep going, Shalako.
Mike Griffin, they're asking, regarding medical receivable, how will a single payer or Medicare for all scenario play out?
That's a really good question. In terms of how medical receivables work, is clearly based on the inefficiency of the U.S. healthcare market. In the event that the healthcare industry becomes much more efficient and the spreads between what actual services cost and what insurance companies are willing to pay for, those spreads will decrease and the opportunities will effectively go away. Now, how that will affect our fund is a situation where it will take years for that to basically deteriorate our returns. As I've said all along, we have a loan agreement with the underlying receivables company, and how they collect on their underlying cases is irrelevant to the loan agreement that we have. But certainly over time, if we in the United States have a more efficient healthcare system, the amount willing to finance that will start to decrease, and then our investors would see a deterioration of that mid-teens to low 20s return. But that, I believe, will take several years for that to come to fruition. And within our fund, we have an initial 1-year lock and then quarterly liquidity thereafter. So investors would have more than ample time to make the decision as to whether the returns are still adequate for their portfolio.
Excellent, thank you so much. And then we have a question for Rafael. As you focus on the mortgages REIT that has collapsed, if we have a paper to bring to you from this mortgages REIT, would you be a buyer?
I'm sorry, one more time? I just have a fuzzy connection. Could you give me that one more time, please, Shalaka?
Yeah, don't worry. Don't worry. They ask you, as you focus on the mortgage REIT that has collapsed, it's a kind of a question. If we have a paper to bring to you from this mortgage REIT, would you be a buyer?
Yes, absolutely.
Okay. Excellent. I don't have more questions, Mike Charlie. I think it's time to you.